How are you guys doing today? Welcome back. It's Financial Education Ranger time. I worked in asset management industry. Today I'm going to tell you about the third option of invest beside growth stock and value stocks during this scary inflation environment. What should we do now? Look at the tech stock that performed well last year. They performed really bad this quarter. Why is that? By the way, please like, share and subscribe to make this channel grow. Let us look at the fundamental. The cumulative fiscal deficit from the start of the recession is larger than that of all 1980 to 2007 recessions combined. The deficit right now is over 30% of GDP, which we haven't seen it before. The recovery, however, has been like no other in recent history. The unemployment rate has recovered 70% of the initial hit in only 6 months. It typically takes around 25 months for this to happen. Right now, it only takes us 6 months. Look at the unemployment rate in United States. Right now it's already 6.1%. The recovery is extremely well. Let us look at the US nominal retail sales. Right now, 575 billion of the 850 billion direct transfer and 2.5 trillion of expected quantitative easing are being provided after the retail sales were above pre-COVID trend and after vaccine confirmation. So it's no surprise that the US nominal retail sales is at all-time high. We have strong growth in the last few months in the United States. Over 30%, and right now is around 7%, which is above average. Let's look at the US inflation index, which is 4% right now. So, since last year, the government prints a lot of money at a speed that we have never seen before. Since World War II, the money supply is below 20%, but right now is above 20%, which is extremely abnormal. So what is the Fed used to do? The Fed deal mandates used to keep inflation at 2% and maximum sustainable employment. Usually at this moment, the Fed will consider increased interest rates. The Fed projection sees inflation slowing to 2% in 2022 before picking up likely to 2.1% in 2023. The central bank has said that it will tolerate inflation slightly above target to make up for the years inflation has been below 2%. From this graph, you can see that most of the Fed members will keep interest rate at 0.25% until 2022. It will not increase interest rate until 2023. Right now, we are going to look at the supply side of the economy. The COVID-19 severely disrupted international global supply chains. In fact, trade declined by over 20%, which exceeded the decline we saw after the 2008 financial crisis. Increasing engagement with international markets is vital to our economic recovery. Dog workers have been ideal in several countries because of spikes in occurrence of the disease. Unexpected demand in shipping has created shortages in ships, containers, and the equipment that converts the containers to truck trailers and drivers to drive them. the ships that are carrying goods are crowding ports, forcing them to wait at anchor outside the port for space to unload their cargo. We have never seen anything like this. We are living through a world history making catastrophic shock to the system. It's really a supply chain problem, which printing money cannot solve it. So what will it end up? The graph already showed you. The commodity index ETF DBC outperformed value stock and growth stock since this year. Right now we are at an environment which is growth recovery right now and inflation keep on rising. So it's favorite commodities. In this investment clock, look at that. So what can we invest right now? Why not? If you guys don't know about future or options, you can use ETF to invest in agriculture, like DBA, Invesco DB Agricultural Fund. The major holdings is corn, soybeans, sugars, coffee, wheat. Look at the retail price right now yourself. It's already rise a lot. That's why the DBA fund increased a lot this year. If you guys want to invest in energy focused fund, DBC is an option. Invesco DB Commodity Index Tracking Fund, the main holding is coal, gasoline, New York Harbor ULSD, Brent crude and corn, gold, soybeans, sugar. Look at the return for these two funds compared with growth stock, S&P 500, and S&P value stock, and even tech stock. Both DBC and DBA outperform all the other funds. Right now, it's not about growth stock and value stock that you should focus on. It is commodity. In the investment world, always choose the easy path to achieve your goal. If stock doesn't perform well, why not choose commodity? It's nothing wrong to choose a commodity that performs better than stock. The trend is your friend. Pick the strongest trend. Please subscribe, share, and like this channel. See you in the next video.